Here's our agenda for today. We will first cover last week's economic data. We'll have a look at where rates and yields are as of the end of last week. Going to look at Trump and the Fed. A Wall Street Journal article that came out late Wednesday was in Saturday's Wall Street Journal front page. And we'll put a dilemma to DeepThink and see what it comes up with. Real yields and OAS, plus we'll look at the economic calendar coming up this week. Big economic risk events this week. SPY, we'll have a look at where that ended last week. No earnings coming up this week. No earnings. And our spotlight company is Vertiv. We'll be looking at understanding thermal management. Vertiv is number one in thermal management. It does a whole bunch of other stuff, but it does this. Also, in the description box is a link to join a Discord. 50. It is good for 50 for 1 week. So the link is good for 1 week, and it is the first 50 starting in 2026. I will be expanding what is available to the A1s. When you are not part of the applied level, you have a tag of A1, which means that you can see only certain things. We will be expanding some of the things that you can see in 2026. The 40-point infographic that we develop for each company each week, I post on Discord either Wednesday or Thursday for the Sunday. So if you're on Discord, you get to see early what the target company or the spotlight company is for Sunday. However, in the description box is a link to leave your email. And every Friday at 4 p.m., we will just email it to you. We're getting about a 38% open rate. But we have to pay for 1,000. Well, by the thousands. Every 1,000 costs us money. We pay for 1,000 and only 380 open it. So we have the email names of those who don't open. We're going to start deleting them because it's just costing us money. If you're not interested in them, you signed up, you thought maybe this will be neat, you see it in your inbox, you go, I don't really care, and you delete it. Well, then we'll take care of that for you. Or check your spam folder. More than likely, these things are showing up in your spam folder, and you're not even knowing that you're receiving them. And you thought, I signed up and I never got anything. Check your spam folder. Once you click on not spam, it shouldn't end up there anymore. But we'll wait 1 more week. Once we send out the emails next Friday, by the time we get to the following Wednesday, whoever has not opened for like 2-3 weeks in a row, we're simply just going to delete the name because it does cost us money to carry you. As usual, do me a favor, click on like. The algorithm, it's really important for the algorithm. You click on like, you click on subscribe so that you get a notification every time I post. I only post twice a week, so it's not like you're going to get a notification 4 or 5 times a day. I only post twice a week on Sundays with this video. And then on Discord, I get a whole bunch of questions under the video on Discord. I answer those in a Q&A on Wednesday. So it's not like you're going to get buried with 5-10 notices every day about nonsense that I'm doing here and there. Maybe every now and then I'll post one. But it's really for the algorithm. Okay, let's head in. We'll start this week with some of the economic data from last week. We got some data. Much of it's still from September. ADP, Employment Change Weekly. The week before was negative 13.5. This is 4.75. And we have JOLTS for September and October. The openings pretty much hanging out at 7.6 million. The quits here September and October. September 3.1 million, dropping to 2.9. Usually when we feel good about our prospects of getting another job, quits rate tends to be higher, because we can say, look, I can do better somewhere else. In a tighter job market where we think, well, it's not going to be that easy to find another job, the quits rate tends to drop. And that is a big drop from September to October. Employment cost index. This is for Q3 ending September 30th. We should have got this October 31st, but we got it in December. So this is representing up to the end of September. Wages, there's the more important component, was 1% a quarter ago for quarter two, dropping to 0.8%. That is disinflationary for sure. Benefits up slightly to 0.8, but overall from 0.9% to 0.8%. Heading to Canada, Bank of Canada unchanged. That was not really much of a surprise. We get Canadian CPI next week. Let's see if it gives the bank permission to cut at the next meeting, or if the next meeting we're off. That's going to be a big risk event for the Canadian dollar. Canadian dollar is printing a 7 handle now, 1.37 and change. A few weeks ago, it was over $1.40 to the US dollar. One US dollar got about $1.40 and a half Canadian. Now it's getting just shy of $1.38. Canada balance of trade, backwards looking. It is for September, but it is telling. We do have a trade surplus. This is with all the countries we trade with. I didn't dive deep to see which countries flipped over, but the expectation was for a deficit. Exports way up, 64 billion versus 60 billion, and imports down 66 billion to 64 billion. I know that a lot of the imports from the US, even though there is no tariff on them, it is more of a nationalistic movement in Canada to boycott anything US. Trips across the border are down some 28%, which is significant. The hit to American alcohol is about $1 billion a year. I don't know that Canada is the only country that's doing that. I'm sure other countries are saying, let's find a way around the US, because when we head over to the US for September, we see something really odd here. When we got the numbers, we saw the negative 52 billion down from negative 59 billion, which is a big drop in the deficit. However, 6.1 billion was gold. Gold was rushing into the country for fear that there would be a tariff on gold. When that didn't materialize, arbitrage allowed that gold to be traded out of the country. 6.1 billion was exported out, so that drops off the exports. If you GDP adjust it, meaning since this would not show up in GDP, only the components that would hit GDP, negative 3.2. So you did have a contraction in the trade deficit. However, year to date, the deficit is up 17%. We've been at tariffs since April. A little before April, you had the 10% or 15% across the board. Then you had the physical spreadsheet that Trump held up. You get tariffs and you get tariffs, and you've had some form of tariffs since then. And year to date, the deficit is still up 17%. So this could be, if we look at exports, 280 to 289, that's a nice jump up. 340 to 342, imports are up. But again, for the exports, you have to take off the 6.1 billion in gold. It could be that other countries are doing the same thing, are saying, look, let's see what we can do to find a way around the US, which would help other countries' trade balances, as we see here with Canada. This is for the same month. I'm throwing out a hypothesis. I don't know without diving into the numbers, but I do see it in Canada. So I wonder, do you see it in other countries? I'm not in other countries, so I can't really tell if there is a let's see what we can do about not buying American. Maybe in the comments section, if that is going on, let me know. I know there are some things you just simply can't avoid at all. You want an iPhone, It's just that simple. But are you making decisions here and there saying, well, there's a local version of this, or I'm not going to buy the American version, I'll buy the German version of this. I know that's going on in Canada. Initial jobless claims jumped to 236 from 192. 236 in December. Interesting. Continuing jobless claims. That's a big drop down. 1,838,000. So that obviously requires a question, and you have to go digging around to see what's going on. The majority of that was falling off. The the limit here is 26 weeks. After that, you drop off the rolls. And that's what happened is those that were on it, for lack of a better word here, they aged out. They don't get week 27. So it's not as if that is a signal that, oh, look at all these people who got jobs. It's, no, look at all these people who lost even that benefit now. Let's look at rates and yields. We had a Fed cut last week, and that press conference was wonderful in talking about inflation. Made the mention that if you remove the effects of the tariffs, their target is in the low twos. They're almost at their target without the tariffs. And earlier, like 4 or 5 meetings ago, Powell did say they would be willing to look through the tariff increase because it's a change in the price level, not a change in the rate of inflation, a one-time adjustment. But in this press conference, he did say, we are here to make sure that that does not become ongoing price pressure. I think they're probably done for now. 3 cuts in a row, thank you. I don't expect one for January. We'll see the probability soon. I think that's the right move, unless the data give them permission. But I do expect another cut before he leaves, because when asked about his legacy, he said he would like to get to a point where they are at neutral or near neutral, which probably is 1 or 2 cuts down. But I think he'll go one more for his legacy if the data allow, which I think the data will. So I think we'll get one more cut before he goes. And then we'll look at a Wall Street Journal article about where Trump is in his pick. The 3-month is reflecting the full 3 cuts we had this year, down 74 basis points. The 10-year, which is an important lending rate, is roughly about half of that, 0.39. All your mortgages are based off the 10-year, and car loans are based off the 5-year. So the lower the 10, the lower the 5, the lower car loan rates and mortgages go. And mortgages and housing have a lot to say about the health of the economy. The 30-year, just not coming along, going the other way altogether. We're going to look at an interesting way that the Treasury can get this down without having the Fed buy anything. And I think it's probably a wise thing for the Treasury to do. Right now, if you look at where rates are, look at the 3-month, you're at 3.63. So if you're issuing debt, you know this rate is going to come down by the end of the year. You can lock in 3.63 for 3 months. I don't think the fear is that rates are going higher, which means if you roll that over 4 times, you're more than likely to get a blended rate that's lower than 3.63. But if you issue 10-year debt, you're going to pay 4.19 for the next 10 years. So if you were faced with a whole bunch of debt and you had to do some money management as the Treasury Secretary, you would say, look, it makes a lot more sense to roll this over for the next 4 quarters than it does to issue 10. So you can starve the market of 10-year issuance. Just cancel 10-year issuance altogether. Some companies have to hold the 10-year, the 20-year, the 30-year. They need duration. They got to hold that stuff. So if you stop issuing that stuff and just focus on money market securities, which the Treasury can do, you can do quite well on the long end by bringing that down without having to buy a single security because you create scarcity. We'll look at that strategy. I asked DeepThink a question. Now that the Fed has preempted the decision for the Fed presidents and taken that away, what has Trump got left? And we'll see what DeepThink strategizes for what his next move will be. Banks had a great week, 3.65%. And again, think about the balance sheet of the bank, right? Assets, liabilities. Liabilities are tied to the Fed funds rate. If you can get money market rates down, that is what they borrow at. They borrow at the short-term rates. and they lend longer in the curve up here. So their liabilities, their cost of financing has dropped, so banks will have a good time with that. And there they are. And the steeper the slope, the better the time they'll have as well. Well, let's have a look at what happened to slope. The 2s to 10s are 67 basis points. That's 9 basis points higher. Lower rates, lower short rates, and a steeper slope, both of those things benefit the banks. Look at that, 3.65%. They're up 11.15 year to date. Add that yield of 2.39, you've got a 13% year to date return. S&P with its yield is at 17%, just shy of where the S&P is. Dollar index took another move downwards. Looking at longer interest rate sensitive, you had not much action on the long end of the curve here, and REITs pulled back, and TLT pulled back. I have partially given up on TLT. I have puts and I have shares. I've closed my shares because enough is enough. No one can say I haven't been a friend to TLT for the last 2.5 years. I've been a very good friend. I've been a loyal friend, but enough is enough. You cheat on me enough times, I give up. So I closed TLT, but I didn't want to lose the duration. I just wanted to lose the market. So I went into the 2042 and I used principal strips. And if you know principal strips, those are zero coupon bonds. I got a 4.89% yield to 2042, zero coupon, no withholding. TLT pays a dividend. As a non-American, I lose. The government just grabs 30% of that dividend right away. If I buy a bond, government grabs 30% of that interest. This is zero coupon. There's nothing to grab. It is efficient. 44 cents on the dollar. So you buy, 440,000 of this. And it matures at 1 million. And I have a duration of 17 on that, which is a slightly higher duration than TLT. And what I have going for me on this is, as time goes by, no matter what it does, it will over time get pulled to par. I don't have that benefit with TLT because it is a rebalancing portfolio. Whereas with this, it will just be pulled to par over time. Next year it'll be a 16-year bond, then a 15, then a 14, and I don't need it anyway. So I do have the duration component in here. If duration performs and TLT does go up because duration, the long end of the curve comes down, so will these. So will those. And I don't have a management fee with that. And I don't have a withholding with that. So as far as income goes, it's far more efficient. And as far as its exposure to the long end of the curve, it's slightly greater at 17, which means I won't miss the move if the move happens. I could just sell out of these if the move does happen. I don't have to hold them to that time. But I do have the added benefit that if I do hold it, TLT may not go anywhere, but these will be pulled to par. So it was a no-brainer at the end of the year to do that. So if you're sitting on some tax losses and you're holding or some taxable gains and you're holding TLT with an unrealized loss, if you close TLT and move into that bond, it is a different security. So the wash rule doesn't apply to you. It's a great way to keep the same factor exposure, to benefit the same way that TLT would in a more efficient way, and to generate a tax loss against the gains you would pay. So if you pay 25% in terms of capital gains, you just made 25% of that loss back right away. IWM, look at that, up 1.23, SPY down 0.57. Small caps love rate cuts. In a rate cutting cycle, small caps will outperform. My forecast is for those rates to continue to go down. I think IWM, small caps probably in 2026 outperform large caps on the basis that you do continue to get those cuts and everything is conditional, right? And the economy doesn't fall apart. XLP, this is a safety play. XLP up 1.22%. Q's down 2%. There is some question based on earnings we had this week about the build out of all the AI infrastructure. We saw CoreWeave already say in their last earnings that they just can't build it fast enough because it can't be done. A critical part of the supply chain is not satisfying the demand available, so it's not as if they don't want it, they just can't. Oracle has sort of said the same thing. They've pushed out their CapEx a little bit further. In their conference call, they said, listen, our CapEx is not as high as you think it is because of this and because of that. And then a couple days later, they said, well, we're going to delay one thing. And then that sort of questioned everything. Is if this is where we are, and these models are good, maybe the period of effectiveness is over and it's time to enter a period of efficiency, which is when I put out my year ahead at the end of this year, my themes for 2026. That's going to be one of the big themes. I'll give it away now. Is that 2026 will be the year where AI pivots from effectiveness to efficiency. And if it does, a lot of this AI infrastructure trade is going to reprice. Let's look at my forecast for the end of 2026. It hasn't changed. In fact, I think I'm not aggressive enough. Effective federal funds rate 2 to 2.25. We are at 3.64. Trump wants it 1% or lower. We'll see that shortly. The 10-year 3 to 3.5. We're at 4.19. Slope, the 10-year, 2-year slope 75 to 100 is what I had forecast. We're already at 67. We're only 8 basis points away from the lower end of that. And the 3-month of the 10-year, 100 to 125. We're at 56 ZQ, sitting somewhere slightly below 98. We're sitting somewhere slightly below 97 right now. This is for December ZQ. Let's look at Fed funds futures. The effective federal funds rate is 3.64. I expect that to pull back to 3.58, 3.57, even without a rate cut, only because the Fed is now buying $40 billion a month, on top of the $15 billion they're buying because that's what matures in mortgage-backed securities. They're rolling it over, but in treasuries, along with the $5 billion that they said would end December 1st. There was $5 billion rolling off. That's not rolling off anymore. You got $60 billion plus whatever is normally rolling off. So the balance sheet is going to increase by, well, not increase by about $40 billion a month, but you have the incremental $20 billion a month from the ending of QT, which started December 1st. $60 billion incremental that wasn't around in November 1st, $720 billion over the course of the year. Now, it is not technically quantitative easing. We've been hearing on YouTube with other commentators saying the Fed is doing QE all over again. Let me go over to the yield curve chart over here and explain why it's not quantitative easing. The key word there is easing. You want to lower rates other than the rate that you control, which is the effective federal funds rate, which doesn't have a time. It sits over here. But you want to lower rates along the curve. Usually when we talk about quantitative easing, we draw a line here. This is money market. This is capital market. We're talking about the capital market curve, as you want to get these, well, we're on the blue line right now, so let's get rid of that. You want to get these lower. So what you can do is you could concentrate buying on those tenors, the 5-year, the 7-year, the 10-year, and you would drive the price up to push the yield down. That is quantitative easing. You're easing monetary policy on the long end of the curve. This $40 billion is T-bills because the Treasury is leaning towards issuing even more T-bills. Well, because it is a floating rate that's going down. To me, I would perfectly agree with that as a strategy to minimize your interest costs because you're minimizing taxpayer spending at that point. Who doesn't want that? So it's technically not quantitative easing, because in focusing on the money market, they are not going to move those money market yields. Nothing will change. They're now avoiding the long end of the curve. More supply is going to show up here, so they're showing up with more demand, hoping that that is balanced. Now, if more supply wasn't showing up here and they were demanding, they would be squeezing $40 billion out of the money market into the capital market. You could say that's a backdoor way of quantitative easing. You're not doing it directly, but they're not doing that. They probably have it on good authority from Bessent himself that he plans to issue even more T-bills and just roll those over and starve the capital market. And if he starves the capital market, especially at the 10-year, there are institutions that have to hold the 10-year, whatever is available. What's available is, well, a 20-year that was issued 10 years ago, a 30-year that was issued 20 years ago. There's lots of those. There's lots of 10-year securities that are not necessarily originally 10-year bonds. It would then begin to drive the 10-year down because, well, if you got to hold it, you got to find it somewhere. And the slope between the 10 and the 30 is not suddenly going to spike like this because you can make the decision at some point when the slope is too high, I'll hold the 30 for 10 years instead of holding a 10-year for 10 years. Could do that. So this is why I say I don't know that you would call this quantitative easing. This is probably well in the realm of reserve management, is making sure that you are above the ample level on reserves. So there we are. So with that, I seem to think that the effective federal funds rate, which gained 6 basis points out of the tightness that we had, should give them back. We should see those drift back. Let's see if that happens. This is what we have. Q1, markets pricing in 14.5. Q2, 19.5. Q3, 15.5. Q4, 6.5. Fully under Trump. We're not going to get anything. We're not going to get anything at all. 55.5 basis points. 2 cuts over the next 8 meetings. 5 of those meetings without Powell. I still have 500 contracts on ZQ, by the way. We go all the way out to April 2027. There is ZQ implying 3.09. That is 55 basis points. In fact, April 2027 is half a basis point lower than December, implying even tighter at the margin under Trump. That is 2 cuts in 10 meetings, 7 of those without Powell. I don't know that there is anything as mispriced in the market other than Tesla as this. This to me seems like a no-brainer. Let's before we look at real rates, let's just have a look at where Trump is on this. All right, this was in the Wall Street Journal, Saturday edition. It hit Friday night, but it was in the front page Friday. Trump says he is leaning towards Warsh or Hassett to lead the Fed. About 2 months ago, I asked DeepThink, out of the 5 candidates, which one is most likely. Google DeepThink said Warsh. And it seemed like it was either Bessent or Hassett, and Hassett was getting it because Bessent didn't want it. But looky here, look who's back on the docket. Warsh. He is more aligned with Trump. In an interview with the Wall Street Journal, Trump said the next Fed chair should consult with him on interest rates. And he said, this because I'm pretty smart about this. If you have to tell people you're smart. He thinks you have to lower interest rates, Trump said of Warsh, and so does everybody else I've talked to. Of course, they said they have to lower rates, everyone you've talked to, because you won't talk to anyone who says you don't have to. So there's confirmation bias. But I do agree, probably not for the same reasons, but I do agree that the U.S. cannot, at this point, if it continues on, if we think about, well, where are we going to get responsibility? from the Fed, from the Treasury, or from your elected officials. Don't look to your elected officials, which means the Treasury and the Fed have to be the adults in the room. Politicians will keep spending. That deficit will get worse. You got to make debt free. There is no way around it. Otherwise, you're driving headlong to the edge of the cliff. Trump said he thought the next Fed chair should consult with him on where to set interest rates. Consult with him on where to set interest rates. Asked where he wants interest rates to be a year from now, Trump said 1% and maybe lower than that. I asked DeepThink, how's he going to get this done? The new Fed presidents have been reelected for their next 5-year term. More hawks will be in that group of 5, the voting 5. More hawks will be on that than doves. How's he going to get this done? We'll see what it said. He said rate cuts would help the U.S. Treasury reduce the cost of financing $30 trillion in government debt. That is, you cannot argue with that. That is absolutely true. Absolutely true. We should have the lowest rates in the world, he said. Canada is at 2.25%. Canada is at 2.25. You think he doesn't see that and see it as a loss of bragging rights? We have higher rates than them. He wants lower rates. We have the lowest rates in the world. No president's ever done anything like this. No one's ever seen anything. He needs to brag. 1% and maybe lower. That would put ZQ at 99. I'm saying I'll be somewhere between 97, 83, and 98. That seems to me like a good exit position. Let's see how this plays out. I might stay in the car for another little drive down the street if we get there. It's enough to say it, but can you get it done? Let's visit DeepThink with that question. Okay, so I laid out the situation. The Board of Governors has reelected the 12 regional presidents, stripping Trump of the ability to pick and choose. You have a Supreme Court decision in January regarding Lisa Cook, which he may lose. And even though Powell will not be the chair, his governor role is still in play. He may not leave. What can Trump do now to get rates to that 1%? Given all of that, you tell me what he can do. Phase 1, the Hassett pivot. Solving the chair problem. Since Powell might refuse to leave the board in May, Trump cannot wait for a vacancy that might not appear. He must use the January 2026 vacancy to install his future chair. Instead of simply renewing Mirren as governor, Trump nominates his intended Fed chair, Kevin Hassett, or Mirren himself. DeepThink is not considering Kevin Warsh, but you get the idea. Whoever is going to be the Fed chair will take that seat. The checkmate. This gets the future chair onto the board early. When Powell's term as chair expires in May, Trump designates his new governor as chair. Powell effectively becomes a zombie governor, stripped of agenda-setting power, while Trump's appointee takes the gavel. I seem to think that Powell would resign as governor because he's worth a hell of a lot more in the real world. These people don't get paid a lot, and his legacy's done. Why stay and suffer abuse? His legacy is done. Off he can go. I seem to think that he'll resign, giving 2 positions, the Mirren seat and the Powell seat. Phase 2, securing the magic number, 4 votes. Trump starts with 3 likely votes, Waller, Bowman, and the new chair. To control the board's administrative powers, he needs 1 more vote to flip the 7-member board. Target A, Lisa Cook. If Supreme Court rules Trump can fire her for cause, he replaces her immediately. Target B, Michael Barr. Barr's term as vice chair for supervision ends in July. Trump refuses to renominate him and can strip him of his staff and regulatory portfolio. Facing irrelevance, Barr may follow precedent and resign his governorship, opening up the 4th seat. Even if he gets Lisa Cook, he'll still do that with Barr. Why not get 5 if you could, right? So there is some window open. However, Waller and Bowman, got a bit of a problem with this. While they do, at this point in time, support further rate cuts, I don't see them staying on board the Trump train all the way to 1%. They're not loyalists. They just happen to agree that rates should be lower right now. They are Trump appointees, but they're not Trump loyalists. They are independent thinkers who just happen to think the same thing, comma, for now. So I don't know that I would continue to count on Waller and Bowman, but to squeeze one or two, maybe even three more cuts out, I think you can continue to count on them. Lisa Cook, Michael Barr. That's where the focus will be. I'm pretty sure Powell will resign. That gives Trump 2 votes right away. And we'll see what happens. He's got Waller and Bowman. So the next 2 cuts, if you get no cuts in the next 3 meetings, you're going to get 2 cuts very quickly coming out of that. Phase 3, the discount window arbitrage, the real nuclear option. Once Trump has 4 votes on the board, he can bypass the FOMC entirely. While the FOMC sets the target rate and the reverse repo rate, the Board of Governors has sole statutory authority to review and determine the discount rate. Trump board votes 4-3 to slash the discount rate to 1%. This inverts the market corridor. The Fed would be offering to lend to banks at 1%, while the FOMC is offering to pay 3.5%. The infinite money loop. Banks could borrow unlimited funds from the discount window at 1% and buy T-bills or lend account prices at 3.4%. The SLR kicker. To make this threat credible, the board, which sets capital rules, can vote to exempt these Fed borrowings from the supplementary leverage ratio. This gives banks the regulatory capacity to borrow trillions. The result, the Fed's balance sheet would explode as banks arbitrage the difference. To save the Fed from financial chaos, the FOMC would be forced to cut the repo and target rate to match the board's 1% floor. Well, that's bold, right? That's why it's called the real nuclear option. The fiscal dominance, the treasury lever, phase 4. This seems more in line with what we could expect. If the board fight stalls, Trump uses Treasury Secretary Scott Bessent to force rates down without the Fed, and Bessent will do Trump's bidding. He always does, with a smile, and defends it. The bill flood. The Treasury announces it will stop issuing 10-year and 30-year bonds, funding the deficit exclusively with short-term T-bills. Why not? If you have an upward sloping curve and you need to borrow and you think that rates can go down, borrow on the short end of that curve. The effect, this creates a massive shortage of long-duration assets. Pension funds and insurers, who must own long bonds, bid up the price of the existing supply, crashing yields. The outcome, this forces mortgage rates, which track the 10-year Treasury, down toward Trump's goal, effectively bypassing the Fed funds rate entirely. Trump's winning hand is to use the January vacancy for his chair, secure a 4th vote, and then use the board's power over the discount rate and SLR to create a market crisis that forces the FOMC to capitulate. That is a lot, but I want you to ask yourself, would you put it past him? Would you cross it off the list and say, oh, he'll never do that? I don't think so. Not high probability. High probability is him doing what he does. Name-calling and bullying. Name-calling and bullying, and using the Justice Department to investigate every little thing you've ever done. So fall in line or resign. This is more strategic. I see the Treasury doing something as more likely than lowering that discount rate to 1%, because you're going to cause a whole lot of problems doing that, and I think you should be able to at least talk them out of that. Real yields all increased last week, and break-evens slightly higher than 20 and 30. Not much to see in the middle of the curve. And corporate spreads, either nothing or slight contraction. Year to date, they're all down except for CCC. And for real yields, year to date, they're all down except, well, there you go, the 30-year. Gold, you had a lower dollar, but you had higher real yields. So that's sort of mixed, but gold decided, let's go up anyways. Silver, again, the volatility in this thing. It's a meme stock. It doesn't belong here. It is momentum. Be very careful with this thing. This thing can drop $2-3 just like that, go up $2-3 just like that. It is beyond all its fundamentals at this point as both an industrial and a precious metal. But look at this year to date, 114%. Is there anything else that has done that? 114%. Oof. Copper and aluminum both up. Now, copper is up 27% for the year. Aluminum up 12.5%. These are industrial, purely industrial metals, but down for the week. Oil down 20% on the year, lost 4% last week. Natural gas took a dump, down 22%. Still up for the year. Record LNG exports. You would think, well, that's natural gas leaving a country that's going to be cold this winter. But November also had record production of natural gas. So you get mixed signals. Inventory levels right now are turning over, but they are above the 5-year average at this point in time, but they will cross under. And we are in backwardation if you look at the first 3 contracts of the year on nat gas. Nat gas is interesting to watch. Deadly to play. Absolutely deadly to play. Wheat, corn, soybean all down for the week. And wheat, corn, soybean as the basis of all processed food that you buy, down for the year as well. So you have energy and food coming down, soy not so much. For the mortgage-backed security and mortgage REIT sector, not a good week at all. The ETF for mortgage-backed securities down slightly, but agency and Annaly giving back 3%. Still up nicely for the year. If you look at Annaly, 21.15 along with a 12.6% dividend yield. Agency had the 12 and the 14, or 26% year to date. Easily beats the S&P. Easily beats NASDAQ. Think about that. Easily beats NASDAQ. But nothing beats silver. Mortgage rate 6.22. Got to start seeing a 5 handle on that if you want life in the housing market. Once you get to 5.5 and you start pushing down towards 5, yeah, I think that housing will do very, very well. January 28th, FOMC, 75% probability of nothing happening, up from 65% a week ago. I think that's right, unless you have, we're going to find out this week, we get a lot of data this week. The economic calendar is full of risk, and we have no earnings now till, I think, January. With Christmas coming up, no one's going to report anything. 75%, 25% on a 25 basis point cut. The data this week will change those probabilities, but 3 cuts in a row, unless the data really shows it. You get CPI, you get jobs this week, unless the data really shows it. If it's mixed again, the job market needs help, but inflation, then probably the probability of nothing heads up to 1. I'm fully expecting that this is going to be the outcome in January. Let's go right to Powell's last stand. That is April. He has 3 meetings left under him, and this is the distribution based on now to then. No rate cuts at all. 37% probability that over the next 3 meetings, you're going to get nothing. 1 cut has a 44%. Now, if we think 36.9, 37% on 0, that means there's 63% probability of at least 1 rate cut. 43% of this is on the 25, 17% is on the 50, 2.2 is on the 75. Almost non-existent here, but it's 2.2 on the 75. So what you're saying is there's a chance. Reverse repo, the lowest since its explosion over $2 trillion under Biden. 838 million. Under $1 billion, 838 million, the lowest. It's probably going to hit 0 at some point. Repos, non-existent. They're not even there. But look at reserves and the TGA. The TGA is down 103 billion from last week, and look at reserves up 95. That's what I've been saying, is that you'll get the reserves back up when the Treasury starts paying people, starts sending out those paychecks. As you pull down the TGA, that money then goes into other bank accounts, which are reserves. So you have an almost one-for-one change, reserves up. So because the TGA is coming down, reserves are going up. The Fed will be adding to reserves at another $40 billion a month. That's why I expect the effective federal funds rate to ease and give back those 6 basis points that it claimed during the call it sniff or whiff of lack of illiquidity or lack of liquidity, because it really wasn't a lack. It was just, maybe it is. So come on, give them back now. This is a Fed projections for 2026, the Fed governor projections for 2026 and for 2027. Negative 26.5, 3.375 is the median in 8 meetings. One cut in 8 meetings for the median. Going over to 2027, it's 3.125. That implies 2 cuts from where we are now over 16 meetings. I don't know, like I said earlier, if there's ever, if I can find anything right now that is as mispriced as ZQ. I was about to do a Trumpism. I don't know if anybody's ever seen anything like this. I'm hearing a lot of talk about this. No investor has ever suffered as much as I have with ZQ in the history of all investors. No one's ever seen anything like this. Okay, let's go through our calendar and see what we have as risk events this week. Big one here for Canada. Monday, right at 8:30, out of the gate, we're going to get November inflation rate. That is going to reprice the dollar almost instantly. If you want to see the effect it has on the currency, because that's where it's going to show up first. Big risk events show up in the currency first. Have a chart of the US CAD open at 8:30 when it happens, and just watch what happens to the bars. It reprices instantly. Mirren talking at 9:30, and we get the National Association of Home Builders Housing Market Index. It has been ugly for a while. Last reading 39. Anything under 50 is contraction. It has been under 50 for quite some time. Williams, we have Williams at 10:30, an hour after Mirren. Mirren is for a rate cut. Williams is for a rate cut. So based on what they're saying that day, we don't have anybody showing up saying, oh, well, it shouldn't happen. So ZQ might be influenced by what they have to say. Maybe ZQ will have a good Monday. ADP employment change weekly we get, and look at what we get hit with at 8:30 on Tuesday. October and November non-farm payrolls. For October, we're only getting the establishment survey, not the household, so you won't have the unemployment rate. But we should get everything for November. All at one time. Like, that's a lot. We also get retail sales. There it is right there for October. Retail sales for October. We should be getting November, but we got October. We'll live with what we got. That is a big data dump at 8:30 for Canada. That's a huge event on Monday. Huge event on Tuesday. Let's see what other things we have going on. Going into Wednesday, anything exciting at 8:30? Waller is speaking at 8:15. Williams speaking at 9:05. We have a 20-year bond auction. Bostic is speaking, but he's resigned, so who cares what he says? Going into Thursday, U.S. inflation for November. Another big day. You've got both of the Fed mandates this week. You got jobs on Tuesday. You got inflation on Thursday. If jobs are ugly and inflation comes in surprisingly lower than expected, what a beautiful day for ZQ. But it could easily go the other way and be ugly, ugly, ugly. 8:30. You'll also have initial jobless claims, continuing claims. That's becoming sort of important to watch. Mexico, if you're interested, interest rate decision for the peso. If you're doing anything with the peso, there's a risk event for you. We're at 7.25. The expectation is a cut to 7%. 7%. Let's go into Friday. Retail sales for Canada and some housing data for the U.S. existing home sales and, of course, Michigan consumer sentiment. This is not a big risk day on Friday. After you get past Thursday at 8:30, there are no earnings this week. This will pretty much set the tone to go into the end of the week, but big risk event in macro coming up. Okay, let's look at SPY. We did get a move in the forward estimate. 303.64, closing SPX 68.27 puts us at 22.5. Last week was 23.2. It doesn't like the 23. It keeps coming back down. 22.49. There's your pullback. Rally to 23. Implied volatility pulling back last week with all that volatility pulling back. All-time high, new all-time high. At least it did that. December 10th, 688.48. New all-time high. We are less than 1% away from that as of Friday's close. December 11th, small caps hit a new all-time high, 258.15. You're less than 2% away from that. IJR, 126.73 got to 125.50 on December 11th before pulling back. That is 2% below. Will we see an all-time high on that one? And Triple Q not coming along for the ride. This is a problem. 635. It has not produced a new all-time high, even though the S&P and small caps have gone on to. Triple Q has not. Down 3.5%. Usually these indices roll over before the S&P does. So when we're looking at rallies, you'll have discretionary. If you're looking at discretionary and staples, XLY typically rolls over before XLP, and Triple Q, it typically rolls over before SPY, failing to make new highs, while you have the S&P that has gone on to make new highs. One leads the other. Are we going to get a turnaround in Triple Q, or are we just going to get a rotation and say, oh, well, look, the infrastructure build is probably going to moderate for a while, so a lot of these names are going to have to reprice downwards, but you'll get a broadening out. Could it be that XLY will underperform XLP next year? Triple Q will underperform SPY? You'll have to tune in a couple of weeks for my forecast to figure that one out. Although I'll give you a hint. I don't know yet. I haven't really thought it through. No earnings this week, but we have huge economic data coming this week. Our spotlight company this week is Vertiv, and we're particularly looking at thermal management. And this is how do you handle all the heat that data centers are throwing off as it draws more and more power. As the GPUs begin to draw more and more power, they generate more and more heat, and you have to dissipate that heat. So we're going to have a look at different ways that can be done. Vertiv is number one in thermal management. That's not all they do. They're not a pure play in thermal management. They operate in the data center infrastructure space, which includes thermal management. So they're not quite a pure play there. They don't break out thermal management in terms of a segment. Their segments are listed in terms of geography, and they break that out in terms of geography, but we don't know how much is thermal management, but we know that space is growing fast. 80% of their sales is in data center power and thermal solutions. They compete with Eaton and Schneider on the larger size. But these are far more diversified. Vertiv is more focused. As of the end of Q3, debt $2.9 billion, equity $3.5 billion, retained earnings greater than zero. I point that out because if you go back to Q1 and you look at the equity section, they still had an accumulated deficit. So their deficit has turned to a surplus just this year. 52-week high, 198.40. They're sitting down around 161 right now. They're almost 20% off the 52-week high. The stock is about to enter a bear market if you're down 20%. What caused all of this? Amazon, more than likely, announcing that it has an in-house solution for thermal management. So it doesn't need companies to supply anything. It's developed an in-house solution. This is a problem with the thermal management stuff, is there's no real defensible moat. It can be copied rather easily, and the large hyperscalers can bring it in-house if they want. Market cap 61.6 billion. It would be its biggest risk here, a rotation out of AI. That would reprice it very quickly. Market cap to sales, price to sales, 6 times. This is based on 2025 sales using their guidance for Q4. In other words, the actual results for Q1, Q2, Q3, and their guidance, the midpoint of their guidance for Q4. They are not in the S&P 500. There was some thinking that they would be included, but they are not. PE, again based on 2025, 3 actual quarters, 1 guided quarter, 39.42. If we look at their forward PE, assuming a slightly lower growth rate in 2026 than we saw in 2025, you had 40% growth. Bring it down to 35%, you still have a forward PE of 28. If they were repriced down, if their forward PE was repriced to equal the forward PE of SPY, their stock price would be 132. We're sitting at 161. 2016 spin out from Emerson Electric. They IPO'd February 7th, 2020 from a SPAC transaction. Let's start with understanding what thermal management is and what it's trying to do. We need to motivate the problem first, and it is a problem of physics. It's not just a problem of efficiency. Let's look at some NVIDIA chips here. DGX, the H200, a rack of 8 of these GPUs will draw 10.2 kilowatts at maximum load, which means it produces 10,200 joules every second. Air cooling here at 10.2 kilowatts. Air cooling here is sufficient, and it is the default thermal solution. If you move to the GB200, the 72 rack that has 72 GPUs, it has 120 kilowatts, or it draws 120 kilowatts of power, producing 120,000 joules per second. Air cooling is not going to get that done. It has to be removed. Air cooling has practical limitations at about 30 kilowatts to 50 kilowatts per rack. This requires liquid cooling. The heat capacity of water is about 4 times that of air. Also, what's motivating the move to liquid cooling, and that liquid cooling will be the default thermal management system in the future. Chip power densities continue to rise. The more power a chip draws, the more heat it generates, it must be removed. Hyperscale CapEx plans extends multiple years. Liquid cooling offers superior power usage, and it is now a necessity. Different forms of liquid cooling. Let's just look at each one of these. These pictures are generated using Nano Banana. So I look at them and I say, well, you're close enough. I mean, if we look down here, there should have been an arrow going this way. I'm not sure what this coolant return loop is. It should probably still continue on like this, to show that water flows through here, but I'm not going to argue with it. It did a good job of getting this done. This is direct to chip liquid cooling. There is this plate, this cold plate that sits right on top of the CPU, and you have cold water that flows through the inside of this. It's not that water is hitting the chip, it flows through this, and as the water flows, it heats up and it pulls the heat out. The heat is blown out, and cool water continues through the loop, removes 60 to 80% of rack heat. You can have single phase or two phase. Bit of a problem with the two phase. Two phase is very efficient. What it has within the water is this liquid that evaporates at about 50 to 60 degrees Celsius. And when it evaporates, it pulls much more heat with it. However, that liquid is associated with PFAS. So it is, not widely used. The two-phase does absorb significantly more energy. Remove 60 to 80% of rack heat. This is on the CPU. However, memory, storage, and power delivery components continue to rely on air cooling. Number 2 is a rear door heat exchanger, RDHX. Removes 50 to 100% of rack heat, and it can be added to existing racks without modifying the servers inside. So here is your rack. You have a front door which has fans. It's pushing cold air into the system, and at the back you have all of your water lines on the back door. Cold air going in, and as that air blows through, the water grabs some of that heat. It heats up, and heated water out, cold water in. Passive relies on server fans to push the hot exhaust air to the back door. Active, there are fans also in the rear door that not only rely on the server to push air out, but these fans suck air out of the inside towards the back door. Immersion, I should add one more thing, brownfield solution. You can modify existing servers with this rather easily. It would be difficult to go through all of those and do direct to chip, but you can put this in rather easily. Number 3 is immersion cooling. It is the fastest growing segment. It's the smallest segment, but the fastest growing. This picture does a good job. There's the server. It is immersed directly into, let's see if I can get my pen on this, immersed directly into the fluid. That's not just water in there. It's a dielectric fluid, which means it's not a conductor of electricity. Each component is addressed because the whole thing is submerged. Again, you can have single phase or two phase, but there is a problem with two phase, so we can just cross that off. If the server is underneath the liquid, it is isolated from dust and humidity and sound dampening. You get all of that at the same time. And the cool fluid flows in. I'm using white on that. The cool fluid flows in. I'm still using white on that. What's going on? It flows in. There we go. Cool fluid flows in. While it's in here, it heats up, and then the warmer liquid rises to the surface, and then the warm liquid is pumped out. You have a heat exchanger down here, which sends the heat in one direction, and the cool liquid goes back in. Now, whatever choice you have, whether it's direct to chip, whether it's rear door heat exchange, whether it's immersion, all of these servers are in a big data center. How are you going to get all the water to every single server? You need a whole system of pipes and water pipes in and out. That is called a cooling distribution unit. If you're going to do any liquid cooling, you need a CDU, and Vertiv is big on that. So just to have a look at how it lays out, here is your server rack. You have cold coolant going in and hot coolant going out. You have to have some kind of system that distributes all of that. So the hot liquid comes out, and you have some heat exchanger somewhere, and then it sends the cool liquid back. Notice that this loop is isolated from this loop. This loop can just use plain old water. This loop has to use a particular type of coolant, which will contain water, but it'll have fluids in there. You don't want to keep mixing them. So it brings the heated liquid into the heat exchanger, and this pushes cold water into the heat exchanger, and the cold water absorbs some of the heat from here and pumps it out. So you have heated water. You have just nothing but water going in, water going out, and you have a closed loop with this coolant in here. So a cooling distribution unit circulates the liquid. Every liquid-cooled facility needs CDUs. What is the market size for liquid cooling thermal management? 2025 estimated at $5.5 billion, 2030 There's a bunch of estimates for it. So if you take an average, you get around almost 16 billion, which is about 23% compounded annual growth rate. Most of the estimates I've seen are between 20 and 30%. So picking a 23 is not too bad. 23% growth rate. And the market breaks down as follows. Hyperscalers represent about 40% of the market. Enterprise data centers about 50. These are just corporations. Every corporation still has a data center somewhere. Doesn't have to be an AI center. There are still data centers, right? Co-location providers. These are your data center REITs, Equinix, Digital Realty, and then you have edge and micro data centers, very small, about 10%. Hyperscalers are really providing the growth beyond what was already there, but they're big enough that they can create their own in-house solution and save significantly. Amazon's done it. And that's why without some sort of moat, it's hard to build a moat on something like this. Without some sort of moat around it, it can be copied rather easily. I shouldn't say rather easily, but they have the resources. The hyperscalers have the resources. I don't see corporations doing it because each one of them, their needs are much smaller, that they're not going to start investing in an in-house solution for that. It's easier just to outsource that. But the hyperscalers, especially when you're thinking about the size of the locations they have, and they may have 2-3 locations in every country. Significant savings by starting to say, well, listen, what are we buying from people and can we do it ourselves? So now that we have an understanding of the market for thermal management, we'll look at Vertiv's numbers. Now, the problem with Vertiv is it's not a pure play in this. It is number one in this. It has a number one market position in thermal management, but it does a bunch of other stuff. So we're going to look at its numbers and make the most of it. So in looking through their 10K and 10Qs for mention of thermal management to see if they give any kind of even narrative breakout of it, I get to these 2 points. This is all I can really get to. 1 point on artificial intelligence. Increased maturity and adoption of AI and high-performance compute is currently impacting the data center industry and driving technology innovation, which has led to increased demand. The company has invested in developing new products, services, and solutions to serve this growing industry, is increasing capacity to support additional demand for AI infrastructure as necessary, and we will continue to invest to support additional growth driven by AI. Okay, great. Here's your thermal management. Thermal management portfolio expansion. We continue to invest in expansion of our thermal management portfolio and product capabilities to meet customer demands. When they say they continue to invest, so far their biggest move forwards have been through acquisition. The complexity of hybrid air and liquid cooling created by AI workloads presents significant opportunities for innovation within and expansion of the entire thermal chain to better optimize performance, power utilization, control, and heat reuse. Some regions demand heat reuse. Europe is a good example of a region where if you're generating above a certain amount of heat, you must find a way to reuse it. Our investment and expansion efforts are directed at capturing new technologies across the entire thermal chain, from chip to heat rejection and reuse, and more to meet growing demands. Further, we are focused on continued growth and expansion of our portfolio geographically as we leverage our best-in-class regional products and expand such offerings into other regions and globally. This is all I could find. I really wish they would break this out, but perhaps if they feel they break this out, they're exposing too much of their business model. I'm not really sure, but I didn't get. It's important to know, I think. Because it's a necessity going forward. Okay. They offer this really nice slide in their investor presentation, and I've updated it with 2025. We have 3 quarters of 2025 behind us. I've updated it with the 3 quarters, but I think it's a nice presentation of key numbers that we should be looking at, and the growth in those numbers over time. Number one, adjusted diluted earnings per share, 53 cents to $1.77 to $2.85. Where are they now? After 3 quarters, they're already at $2.83. They're guiding Q4 to $1.26. That's the midpoint of the range. So they've already got almost 100% of 2024 EPS done in 3 quarters and guiding for another 126. If we look at net sales, 5.7 billion to 6.8 billion to 8 billion. Where are they now? After 3 quarters, they're 7.35 billion. They're 91% of 2024 after 3 quarters. If there was zero growth, it'd be 75%, right? 3 out of 4 quarters, 75%. Q4, they're guiding to 2.85 billion. So they'll be somewhere around 10 billion on their guidance. They're at 8 billion now. 25% growth in net sales. Adjusted operating profit, 439 million to 1 billion to 1.5 billion. What a growth trajectory on that, right? First 3 quarters, they're at 1.422 billion, which is 91%, pretty much in line with net sales. Q4, they're guiding to 640 million. That would put them at 2 billion, increasing roughly 500 billion a year, from 439 to a billion to 1.5 to 2. Let's look at some of the side notes I have here. Q3 2025, the mix between service and product. Service divided by sales, 17.24%. That's just for the 3rd quarter. If you're looking at the first 3 quarters of the year, 17.96%, roughly about 18% of the revenue is service. Does it matter? Let's look at their gross margins. Service gross margins for the quarter, 42.2. For the first 9 months, 41. Versus product at 37. You get roughly about 400 more basis points of gross margin by increasing your service component relative to sales, but it is fairly constant at just slightly under 20%. Let's go down to the bottom row here. Adjusted operating margin. That's why I pointed out the margin up here. You get better margin on services and sales. Look at their margin, 2022, 7.7%. 2023, 15.3%, 2024, 19.4%, and Q3 of 25, they point out they have significant efficiency gains, but tariffs are offsetting some of it. They got to 22.3, so you do have margin expansion, and they are guiding to 22.4 for Q4, well above 2024. The backlog. This is how much business they have contracted into the future. 2022 ended with 4.8 billion as their backlog. 2023, 5.5 billion as their backlog. 2024, 7.2 billion. As of the end of Q3 25, they're at 9.5 billion. And these two numbers here, this was 7.2 at the end of 2024. At the end of Q1, it grew to 7.9, grew to 8.5 by the end of Q2, 9.5 by the end of Q3. They have increasing EPS, increasing net sales, increasing operating margin, and increasing backlog. These are all good things. To know whether this is going to continue, we look at something called the book-to-bill ratio, 1.4. That means we're booking $1 million, but we've only been able to bill 500,000 of that, meaning that we've recognized 500,000 of the 1 million that we booked. That number is greater than 1. That means your backlog is increasing. So as long as the book-to-bill ratio is greater than 1, you can expect the backlog to continue to increase. That's 1.4 on the book-to-bill. All pretty good. Except for one thing. What if the infrastructure build really pulls back in 2026? These hyperscalers say, start canceling orders and saying, let's defer this, let's let this go. We'll delay this a year, we'll delay this 2 years. So your backlog usually has some kind of timeline. And a company will usually say, whatever their guidance is for 2026, that 82% of our 2026 sales are coming from our backlog, unless that gets delayed. That's the big risk. Adjusted free cash flow. No cash flow here. Cash burn in 2022, 778 to 1.1 billion. They are at 1 billion now, which is 88% of where they were last year. And they're guiding Q4 to about 500 million. That will put them at 1.5 billion in adjusted free cash flow, up from 1.13. All the metrics are increasing. The question is this worth 28 times forward earnings, or is it better priced? Because they have no real moat. Most of what they have can be copied. They have no real moat, so should they have a forward multiple closer to the S&P, which would put them at about 130? I seem to think so. So I don't know that I would be too eager. I did sell puts on them. And I think I just got lucky. I sold puts before the Fed announcement, expecting that the Fed announcement would result in a rally. I sold puts on a bunch of things, and I took those profits nicely. And then throughout the week, it continued to drop. So I looked at that saying, okay, well, I played the event right. Thank God I didn't continue playing it. I have Vertiv on my screen, and it pulled back a lot on Friday. I thought maybe I'll sell some puts, but in really thinking it through, I thought the risk of hyperscalers entering an efficiency cycle in 2026 is too high. If they enter an efficiency cycle and they bring in capital discipline, these companies have some downside, 20-30% more downside. So because I think that is my big forecast for 2026, or one of my themes for 2026 is hyperscaler efficiency as opposed to effectiveness, I seem to think that these tail end ones, which have huge volatility, are probably going to show more room to the downside. Now, I wouldn't short Vertiv, but I would certainly play some of its volatility from the short side. There's still a trade to be done there. I haven't decided if that is something that I want to do. I would wait for a rally in the market before I would decide to do it from the short side, but I don't see it breaking its all-time highs again. And that is where we are. If you like this stuff, I ask it every week because it is important to ask. The algorithm for YouTube is very, very clear. The more people that like your video, the more people that comment on your video, the more people that subscribe on that video, the more people who will get to see this type of video. Unless you all want to keep it just a little secret and punish me for that. Give me some exposure. Smash that like button. Not just once. Do it, I don't know, 6, 7 times.